Okay, so picture this. You log into your brokerage app. Maybe it's a Tuesday night, you're on the couch, half watching TV, and you check your portfolio. And there it is, up like 4% for the year. Meanwhile, your buddy from college, the one who posts screenshots of his Robinhood account like it's a vacation photo, is up 30% and won't stop talking about it at every single dinner. And you just sit there thinking, am I doing this wrong? Is my portfolio just broken? You're not imagining it. Your portfolio might genuinely feel slow, sluggish, like you're driving a minivan on the highway while everyone else is in a sports car. And honestly, that feeling, that nagging sense that your money isn't working as hard as it should be, it's one of the most common things I hear from people, and it's rarely because they're doing something catastrophically wrong. It's usually something much smaller, much more fixable than that. My name is Steve, and I spend way too much time thinking about money, about why some portfolios seem to hum along and compound like magic while others just crawl. I've spent years digging into fund structures, reading prospectuses that most people would rather set on fire than read, and talking to people who felt exactly like you might feel right now, stuck, behind, confused about why diversification, the thing every finance blog tells you to do, sometimes just means average forever. And here's the thing I want to tease before we dive in. The reason your portfolio feels slow probably isn't your fault. And it's probably not because you need to take on some reckless amount of risk to fix it. It's usually about structure. It's about what kind of funds are actually sitting inside your portfolio, quietly doing or not doing their job. So today, I want to walk you through 3 specific types of funds that can genuinely change the pace of your portfolio, why they work the way they do, and, just as important, the trade-offs nobody mentions when they're hyping this stuff up on social media, because there's always a trade-off. Always. Let's get into it. So first, let's talk about why your portfolio might feel slow in the first place. And the answer, more often than not, comes down to one word: averaging. Here's what I mean. A lot of people, with totally good intentions by the way, build portfolios that are stuffed with broad market index funds, total stock market funds, S&P 500 funds, target date funds inside a 401k. And look, these are genuinely good, low-cost, sensible tools. I'm not here to trash them. But by design, they're built to capture the average return of the market. That's literally the point. You own a little slice of everything, the winners and the losers pull each other along, and you end up with something that's steady but, well, kind of forgettable. Think of it like ordering the same safe pasta dish at every restaurant you go to. It's fine. It's never going to ruin your night, but it's also never going to be the meal you tell your friends about. Broad index funds are the safe pasta of investing, reliable but rarely thrilling. Now here's the part that surprises people. When you're heavily concentrated in broad, average-tracking funds, you're mathematically guaranteeing yourself an average experience. Not a bad one. An average one. And when the market has a good year, sure, you feel it a little. But when certain sectors or trends are absolutely ripping, like say, a wave of innovation in a specific industry, or a commodity cycle, or a shift in interest rates that favors certain company types, your portfolio barely reacts. It's too diluted. It's like trying to taste a single drop of hot sauce in a swimming pool. The flavor's there, technically, but you're never going to feel it. This is why so many people feel like their portfolio is slow. It's not underperforming in some dramatic, alarming way. It's just diluted, muted, numbed down by sheer breadth. So what's the takeaway here? It's not dump your index funds and go all in on meme stocks. Please, for the love of all that is holy, don't do that. The takeaway is that if you want your portfolio to actually feel something, to have moments where it accelerates, where you can see the needle move, you need some funds in there that aren't just tracking the average. You need funds with a point of view, and that's where the next 3 come in. All right, fund number 1. This is what's called a momentum fund. And honestly, I think it's one of the most misunderstood tools in investing. Here's the basic idea. Momentum funds are built around a pretty simple, almost stubbornly simple principle. Stocks that have been going up tend to keep going up, at least for a while. And stocks that have been going down tend to keep going down, at least for a while. It sounds almost too simple to be true, right? Like something your uncle would say with total confidence at a barbecue. But there's actually decades of academic research behind this. It's one of the more well-documented patterns in market behavior, sitting alongside stuff like the value effect and the size effect. Researchers have studied it since at least the early 90s, and the pattern has shown up again and again across different markets and time periods. So a momentum fund systematically buys stocks that are showing strong recent performance and periodically rebalances, say every quarter, to make sure it's still holding the current winners and shedding the ones that have started to fade. It's not guessing. It's not some manager's gut feeling about which company is going to be the next big thing. It's rules-based, mechanical almost. Let me give you a mental picture. Imagine you're at a marathon, and instead of betting on the runner who looks the strongest at the starting line, you wait until mile 10, see who's actually pulling ahead, and put your money on them, continuing that pace. That's momentum investing in a nutshell. You're not predicting the future from scratch. You're reading what's already happening and leaning into it. Now, why does this matter for the slow portfolio problem? Because momentum funds, by their very nature, are concentrated in whatever is currently working. When tech is leading the market, a momentum fund tilts toward tech. When energy stocks are surging, it shifts that way. It's responsive. It's alive, in a way that a static index fund just isn't. This is exactly the kind of ingredient that can add some pace to an otherwise sluggish portfolio. But, and this is important, so don't skip this part, momentum funds can also be genuinely volatile. They can turn on a dime. When market leadership shifts suddenly, momentum funds can lag hard during the transition because they're still holding yesterday's winners while the market's already moved on to something new. I've seen people get burned, not because momentum investing doesn't work, but because they expected it to be smooth and it's just not. It's more like a jet ski than a cruise ship. Fast, fun, but you're going to feel every bump. The actionable piece here. If you're considering something like this, it typically makes sense as a smaller slice of a portfolio, a satellite holding, not the whole foundation. And honestly, do your own homework on expense ratios here, because momentum strategies often trade more frequently than plain index funds. And that can mean higher costs, which quietly eat into your returns if you're not paying attention. Fund number 2, and this one honestly deserves way more attention than it usually gets. Small cap growth funds. Okay, quick reflection here. When most people think about growth, they think about the giant household name companies. The ones that are already everywhere, already dominant, already big. And look, those companies can still grow, sure. But there's this other category of companies that people tend to overlook, and it's the smaller companies. The ones that are still early in their story, still scrappy, still figuring things out, but growing fast. Small cap growth funds focus on exactly this. Companies with smaller market capitalizations. Think hundreds of millions to a few $billion rather than the trillion-dollar giants that are showing above-average earnings growth or revenue growth relative to their peers. Here's a way to think about it. A mega-cap company, something like one of those trillion-dollar giants, is like a massive cargo ship. It's incredibly powerful. It can weather almost any storm, but turning it, accelerating it, changing its course, that takes an enormous amount of energy and time. A small cap growth company is more like a speedboat. It doesn't have nearly the same mass, the same resources, the same staying power in a storm. But when it decides to accelerate, it can genuinely fly. That agility is the whole appeal. And historically, and I want to be careful here because past patterns are not promises, small cap stocks as a category have shown periods where they meaningfully outpaced large cap stocks, particularly coming out of economic downturns when smaller, nimbler companies can recover and expand faster than their lumbering giant counterparts. There's actual academic literature on this too, going back to research from the early 80s on what's called the size effect. The observation that smaller companies have over long stretches of market history tended to deliver higher returns than larger ones, though with more volatility along the way. Why does this matter to your slow-feeling portfolio? Because if your entire equity allocation is tilted toward the same 20 or 30 mega-cap names, which, by the way, happens more than people realize because those names dominate the weighting in most broad index funds, you're missing out on this entire other engine of growth. It's sitting right there, mostly untapped in the small cap space. Now, the honest caveat, because I promised you trade-offs. Small cap growth funds can be genuinely bumpy. These companies are, by definition, less established. Some of them don't have consistent profits yet. Some of them are one bad product launch away from real trouble. This is not the sleep soundly at night corner of your portfolio. This is the corner where you have to be emotionally prepared for real swings, sometimes 20–30% drawdowns in rough years. That's just part of the deal. So the actionable advice here, and I say this gently because I know it's tempting to chase the excitement, treat small cap growth as a deliberate sized position. Something you're comfortable holding through the inevitable rough patches, not something you panic sell the first time it dips. Because honestly, that's the number one way people sabotage themselves with this category. They buy in during a hot streak, and the moment it cools off, they bail, and they lock in the exact loss they were trying to avoid. Time in the market, not timing the market. I know, everybody says it. It's basically become a cliche at this point, but it's a cliche because it's stubbornly, annoyingly true. All right, fund number 3, and this one is a little different in flavor. This is the thematic or sector-focused fund. So instead of organizing around company size like small cap funds do, or around a statistical pattern like momentum funds do, thematic funds organize around a story, a specific industry, technology, or trend that the fund manager believes represents where meaningful growth is headed. Think clean energy, semiconductors, cybersecurity, healthcare innovation, that sort of thing. Here's an image for you. Imagine the broad market as a giant orchestra. Hundreds of instruments all playing together, and what you hear is this big blended sound. A thematic fund is like pulling just the string section out of that orchestra and listening to it on its own. Suddenly you can actually hear what those instruments are doing. You lose the fullness of the whole orchestra, sure, but you gain clarity, you gain focus, and if that section happens to be playing something extraordinary, you feel it far more intensely than you would buried in the mix. And this matters for the slow portfolio issue because thematic funds let you intentionally lean into structural trends. Things that aren't just short-term noise, but genuine multi-year shifts in how the economy or society is changing. Aging populations driving healthcare innovation, the build-out of energy infrastructure, the expansion of computing power. These aren't guesses pulled out of thin air. They're observable, ongoing shifts, and thematic funds let you position around them directly instead of hoping your broad index fund happens to be weighted toward them by accident. I'll be honest with you though, and this is maybe the biggest, most important caveat of the entire video. Thematic funds are probably the riskiest of the 3 we're talking about today, in terms of concentration risk. You're making a fairly explicit bet that a specific theme plays out roughly the way you expect, on roughly the timeline you expect. And sometimes a theme that seems obvious and inevitable takes a lot longer to actually pay off than anyone anticipated. The story can be right, and the timing can still wreck you. That's happened plenty of times throughout market history. Genuinely transformative technologies where the idea was correct, but early investors got wiped out because the actual monetization, the actual profits, took years or even decades longer to show up than expected. So the takeaway here is about sizing and expectations. Thematic funds are, in my view, best treated as a smaller, deliberate slice. Something you add because you have genuine conviction about a trend, not because a headline or a friend's hot tip got you excited for a weekend. And it's worth actually reading what's inside the fund too. Some thematic funds are more loosely connected to their supposed theme than you'd expect. Sometimes a fund with an exciting name is holding a bunch of companies that are only tangentially related to the story it's selling. Don't just buy the name. Look under the hood. Okay, so here's where I want to zoom back out, because I don't want you walking away from this thinking the fix for a slow portfolio is just add 3 exciting funds and suddenly you're rich. That's not it, and honestly, if anyone tells you that, you should be a little suspicious of them. The real insight, the thing I actually want you to take with you, is that a portfolio's speed isn't really about finding some secret fund that magically outperforms everything else forever. It's about intentional structure. It's about understanding that a broad, average tracking foundation gives you stability and lets you sleep at night, while a smaller, thoughtfully chosen layer of more concentrated, higher conviction funds, like the momentum, small cap growth, or thematic funds we just talked about, is what actually gives your portfolio some texture, some responsiveness, some pulse. Think of your portfolio like a fire. Your broad index funds are the big, steady logs. They're what keeps the fire burning reliably for hours. They're not flashy, but without them, you've got nothing sustainable. The funds we talked about today, those are more like kindling and a little extra oxygen. Added carefully, in the right proportion, they make the whole fire burn brighter and hotter. Dump too much kindling on all at once, though, with no structure underneath it, and you just get a flash that burns out fast and leaves you cold. And look, I want to be honest with you, because that's the whole point of this channel. None of this is personalized financial advice. I don't know your specific situation, your timeline, your risk tolerance, any of it. What I'm giving you is a framework for understanding why your portfolio might feel slow and what kinds of tools exist to address that feeling so that you can go do your own research or have an informed conversation with a financial professional from a place of actual understanding instead of just chasing whatever's trending this week. So let's bring this back together. If your portfolio has been feeling slow, sluggish, like it's just not keeping pace with the excitement you see everywhere else, it's probably not because you've done something wrong. It's probably because your portfolio is doing exactly what broad, diversified funds are designed to do, capture the average, and there's nothing shameful about that. Average, compounded over decades, is still an incredibly powerful thing. Don't let anyone make you feel foolish for building a solid, boring foundation. But if you want your portfolio to actually feel a little more alive, to have moments where you can see it responding, accelerating, reflecting the world's actual momentum, funds like momentum-based funds, small-cap growth funds, and thematic sector funds are tools worth understanding. Not because they're magic, and definitely not because they're free of risk. We talked pretty openly about how bumpy each of these can get. But because they give you a way to intentionally add texture to what might otherwise be a pretty flat, forgettable financial picture. Honestly, the biggest shift I want you to walk away with isn't even about these specific funds. It's the idea that you're allowed to ask why your money is behaving the way it is. You're allowed to look under the hood. Most people never do. They just accept whatever default option got auto-selected for them years ago and never think about it again. And that's fine. That's a choice too. But if you're the kind of person who wants a little more intention behind your money, a little more understanding of why things move the way they move, then that curiosity, honestly, is worth more than any single fund we talked about today. So take it slow. Do the research. Maybe start small. Watch how these pieces actually behave through a few different market conditions before you commit anything meaningful to them. There's no rush here. Despite the whole point of this video being about speed, the actual best investing decisions are almost always the patient ones. Thanks for sticking with me through this one. If it helped you see your portfolio a little differently, that's honestly all I'm hoping for. I'll see you in the next video.